The retail landscape is changing at a pace we've never seen before. Once mighty giants that dominated shopping malls and main streets across America are now facing unprecedented challenges. Today, we're looking at 15 major retail chains that are hemorrhaging customers at an alarming rate. These aren't just minor setbacks. For many of these companies, it's an existential crisis that threatens their very survival. The perfect storm of e-commerce dominance, changing consumer preferences, and the lingering effects of the pandemic has accelerated trends that were already in motion. As we enter the spring of this year, the retail apocalypse shows no signs of slowing down. Let's dive into the companies that are struggling the most and examine why their customers are abandoning them in droves. First up is Bed Bath & Beyond, a retailer that was once synonymous with college dorm shopping and wedding registries. After narrowly avoiding complete liquidation in 2023, the company has continued to struggle with its identity and relevance. Their famous 20% off coupons, once a powerful draw, have lost their appeal as consumers find better deals online. The company closed another 150 stores in the past year, bringing their total footprint down to just over 300 locations, a shadow of their former 1,500 store empire. The most telling statistic? Foot traffic is down 42% compared to pre-pandemic levels, and their e-commerce sales haven't picked up the slack. Industry analysts point to their failure to create a compelling omni-channel experience and their slow adaptation to changing home decor trends. The rise of specialized online retailers like Wayfair and Amazon's expanding home goods selection has left Bed Bath & Beyond struggling to articulate why customers should shop with them. Their recent attempt to rebrand and focus on private label products has yet to resonate with consumers who increasingly value unique, Instagram-worthy home goods over mass-market offerings. Next on our list is GameStop. Despite the meme stock frenzy that temporarily boosted their financial position, the fundamental business challenges haven't gone away. Physical game sales continue to decline as digital downloads become the norm, and the company's pivot to become a tech company has yielded mixed results at best. Their NFT marketplace launched with great fanfare, but has since become an afterthought in the crypto winter. Customer traffic has declined by 35% year over year, and the average transaction value is down as well. The core demographic of gamers has largely moved on to digital platforms, subscription services like Xbox Game Pass, and direct-to-console purchases. GameStop's attempt to diversify into collectibles and PC gaming hardware hasn't been enough to offset these losses. With another 200 stores slated for closure by the end of the year, GameStop's physical retail presence continues to shrink, and their relevance to gamers diminishes with each passing quarter. Our third struggling retailer is Kohl's, a mid-tier department store that's finding itself increasingly squeezed from all sides. Discount retailers like TJ Maxx and Ross are capturing the budget-conscious shopper, while Target has successfully positioned itself as a more stylish alternative with similar price points. Meanwhile, Kohl's has struggled to establish a clear identity in the minds of consumers. Their customer count has dropped by 28% since 2019, and same-store sales have been negative for 9 consecutive quarters. The company's partnership with Amazon for returns initially drove foot traffic, but data shows that these customers rarely convert to Kohl's shoppers. Their attempt to attract younger shoppers through partnerships with Sephora has shown some promise, but hasn't been enough to reverse the overall decline. The retailer's aging customer base and suburban store locations are increasingly out of step with shopping patterns that favor either convenience or experience, neither of which Kohl's has managed to deliver consistently. Fourth on our list is Office Depot, a retailer caught in the crosshairs of digitization and remote work trends. The office supply chain has seen customer traffic plummet by 45% compared to pre-pandemic levels, with more companies embracing hybrid work models and reducing their physical office footprints. The demand for traditional office supplies continues to shrink. Meanwhile, businesses that do need supplies increasingly turn to Amazon Business or specialized B2B suppliers with more competitive pricing. Office Depot's attempt to pivot toward business services and co-working spaces came too late and lacked the investment needed to compete effectively. Their recent announcement of 300 store closures signals a recognition that their current retail model is unsustainable. The company's customer base skews older, and they've struggled to connect with younger entrepreneurs and small business owners who prefer digital-first solutions for their business needs. Fifth is Penney, a retailer that has been on life support for years. After emerging from bankruptcy in 2020, the department store chain has continued to struggle with relevance and customer retention. Their core customer base is literally aging out of the market, and they've failed to attract younger shoppers despite numerous rebranding attempts. Foot traffic is down 38% compared to 2019, and their e-commerce growth has lagged far behind industry averages. The company's attempt to focus on beauty through their partnership with Sephora was dealt a blow when Sephora jumped ship to partner with Kohl's instead. Their replacement beauty concept hasn't gained traction with consumers. With another 100 stores closed in the past year, JCPenney's physical presence continues to shrink, and their brand equity diminishes with each passing quarter. The retailer that was once a staple of American shopping malls is increasingly becoming a footnote in retail history. Sixth on our list is Party City, which filed for bankruptcy in early 2023 and has continued to struggle since emerging with a restructured debt load. The specialty retailer has been hit by a perfect storm of challenges: the rise of discount stores selling party supplies, the growth of online retailers like Amazon, and changing celebration patterns post-pandemic. Their customer count has dropped by 32% since 2019, and average transaction values have declined as well. The company's core business model, selling single-use party supplies at high margins, is increasingly at odds with consumers' growing environmental consciousness and preference for experiences over things. Their attempt to pivot toward balloon-centric celebrations and custom printing services hasn't been enough to offset the decline in their traditional business. With another 150 stores closed in the past year, Party City's footprint continues to shrink and their relevance to consumers diminishes. Seventh is Rite Aid, which has been losing customers to both CVS and Walgreens, as well as to big box retailers like Walmart and Target that have expanded their pharmacy services. After filing for bankruptcy in late 2023, the drugstore chain has closed hundreds of underperforming locations and is struggling to find a path forward. Customer traffic is down 25% compared to pre-pandemic levels, and their pharmacy business, once their core strength, has been eroded by mail-order prescriptions and specialty pharmacy services. The company's attempt to modernize its stores and expand health services came too late and lacked the investment needed to compete effectively with larger chains. Their customer base skews older, and they've struggled to connect with younger consumers who increasingly prefer digital-first healthcare solutions. With another 400 stores slated for closure by the end of 2025, Rite Aid's physical presence continues to shrink dramatically. Eighth on our list is Macy's, the iconic department store that has been a fixture of American retail for over 160 years. Despite numerous turnaround attempts, the retailer continues to lose customers at an alarming rate. Foot traffic is down 30% compared to 2019, and their e-commerce growth has lagged behind industry averages. The company recently announced plans to close 150 more stores over the next 3 years, focusing instead on their higher-end Bloomingdale's brand and Blue Mercury beauty chain. Macy's has struggled to articulate why customers should shop with them in an era of specialized retailers and online convenience. Their merchandise mix often feels dated, and their store environments haven't kept pace with evolving consumer expectations. The department store model itself is increasingly challenged, caught between discount retailers on one end and luxury experiences on the other. Macy's finds itself in the uncomfortable middle, without a clear value proposition for today's consumer. Ninth is Tuesday Morning, which has already gone through bankruptcy twice in recent years and continues to struggle with customer retention. The off-price home goods retailer has seen foot traffic decline by 40% compared to pre-pandemic levels. Their treasure hunt business model, once a strength, has become a liability in an era where consumers increasingly value convenience and predictability in their shopping experiences. The company's inconsistent inventory and haphazard store presentations have failed to resonate with younger consumers who prefer the more curated experiences offered by competitors like HomeGoods. Their recent attempt to improve their e-commerce presence came too late and lacked the investment needed to compete effectively. With another 100 stores closed in the past year, Tuesday Morning's physical presence continues to shrink and their relevance to consumers diminishes. 10th on our list is Big Lots, the discount retailer that has struggled to find its footing in an increasingly competitive landscape. Customer traffic has declined by 35% since 2019, and same-store sales have been negative for 8 consecutive quarters. The company's attempt to position itself as a furniture destination has been undermined by supply chain challenges and increasing competition from online retailers. Big Lots has found itself caught in an uncomfortable middle ground, not as cheap as dollar stores, not as trendy as Target, and not as convenient as Amazon. Their core customer base is price-sensitive, but increasingly finds better deals and more convenient shopping experiences elsewhere. The company's recent announcement of 150 store closures signals a recognition that their current retail model needs significant adjustment to remain viable. 11th is Express, the mall-based fashion retailer that has struggled to connect with consumers in an increasingly casual and fragmented apparel market. Foot traffic is down 45% compared to pre-pandemic levels, and their e-commerce growth has lagged far behind industry averages. The company's attempt to pivot toward more casual offerings came too late, as consumers had already shifted their loyalty to more specialized and authentic brands. Express has been caught in a difficult position. Too expensive for budget-conscious consumers, not distinctive enough for fashion-forward shoppers, and increasingly irrelevant in a work environment that has become more casual. Their recent merger with WHP Global provided some financial breathing room, but hasn't addressed the fundamental challenges of customer acquisition and retention. With another 100 stores closed in the past year, Express's physical presence continues to shrink dramatically. 12th on our list is Joann Fabrics, which has struggled to maintain relevance in an increasingly digital crafting landscape. Customer traffic has declined by 30% since the pandemic crafting boom subsided, and their core demographic is aging. The company's attempt to rebrand and modernize its stores has shown some promise, but hasn't been rolled out quickly enough to stem the customer losses. Joann has faced increasing competition from online craft suppliers and tutorial platforms that offer more convenience and often better pricing. Their recent pivot toward creating community spaces and offering classes is a step in the right direction, but requires significant investment at a time when their financial resources are constrained. The company's announcement of 50 store closures signals a recognition that their current footprint is unsustainable given the shift in consumer behavior. 13th is Petco, which has seen customer traffic decline by 25% as consumers increasingly turn to online retailers for pet supplies. The specialty pet retailer has struggled to compete with the convenience and often better pricing offered by Amazon and Chewy. Their attempt to pivot towards services like grooming and veterinary care has shown some promise, but hasn't been enough to offset the decline in their traditional retail business. Petco's recent push into premium and fresh pet food came as many consumers were becoming more price-sensitive due to inflation, creating a mismatch in timing. Their store environments, once a differentiator, now often feel dated compared to more modern pet retail concepts. With 80 stores slated for closure, Petco is acknowledging that their physical footprint needs to contract as more pet supply purchases move online. 14th on our list is Gap Inc., particularly its namesake, Gap brand and Banana Republic. While Old Navy continues to perform relatively well, these two heritage brands have seen customer traffic decline by 35% compared to pre-pandemic levels. Both brands have struggled with identity crises. Gap's attempt to recapture its 90s heyday has felt forced, while Banana Republic's pivot back toward affordable luxury hasn't resonated with consumers who have many more options in that space now. The company's recent announcement of 350 Gap and Banana Republic store closures globally signals a recognition that these brands' physical footprints need to contract significantly. Both brands have struggled to articulate why consumers should choose them in an increasingly crowded and specialized apparel market. Their core aesthetics, once distinctive, now often feel generic compared to more authentic and focused competitors. Finally, 15th on our list is Barnes & Noble, which continues to face existential challenges despite new ownership and a refreshed strategy. Customer traffic has declined by 20% compared to pre-pandemic levels, though this represents an improvement from earlier, steeper declines. The bookseller has struggled to compete with Amazon's convenience and pricing, though their recent focus on creating more inviting store environments and empowering local store managers has shown some promise. Barnes & Noble's core challenge remains the ongoing shift toward digital reading and online purchasing. Their attempt to position themselves as cultural community centers is a step in the right direction, but requires significant investment at a time when their financial resources are constrained. The company's recent announcement of 50 store closures, while adding some new, smaller format locations, signals a recognition that their traditional big box model needs significant adjustment. What's particularly notable about these 15 retailers is that their struggles aren't just about the pandemic or temporary economic conditions. They represent fundamental shifts in consumer behavior and preferences. The retailers that are thriving today are those that offer either exceptional convenience, distinctive products, or memorable experiences, ideally some combination of all three. Many of these struggling chains are caught in what retail analysts call the messy middle. Not distinctive enough to command premium pricing, not efficient enough to compete on price, and not convenient enough to compete with online alternatives. Their physical store networks, once assets, have become liabilities in an era where foot traffic continues to decline across most retail categories. For investors, these retailers represent significant risk, as their high fixed costs make it difficult to right-size quickly enough to match declining revenues. For employees, the ongoing store closures and restructurings create tremendous uncertainty. And for consumers, the disappearance of these once dominant retailers represents the end of an era in American shopping. The retail landscape of this year is being reshaped by forces that were set in motion years ago but have accelerated dramatically in recent years. E-commerce penetration continues to grow across almost all categories. Consumer preferences have shifted toward more authentic, specialized brands, and the economics of physical retail have fundamentally changed, with rising labor costs and declining foot traffic creating a challenging equation for traditional retailers. For these 15 retail giants, the path forward is unclear. Some will likely disappear entirely, joining the ranks of Toys R Us, Circuit City, and other once dominant retailers that failed to adapt. Others may find a sustainable niche by dramatically reducing their footprints and focusing on their core strengths. And a few may manage to reinvent themselves successfully, though history suggests this is the exception rather than the rule. What's clear is that the retail apocalypse is far from over. The companies that survive will be those that can articulate a clear reason for consumers to choose them in an increasingly crowded and convenient marketplace. For these 15 retailers, losing customers fast, the clock is ticking, and the margin for error is slim. The next few years will determine which of them have a future in American retail and which will become footnotes in retail history.